Welcome, everybody. Good morning and welcome to the very first edition of the Monday Morning Playbook. My name is Scott Brown and I'm the founder and chief investment strategist at Beat the Bench. At Beat the Bench, what we do is investment strategy for investment advisors. The goal of this publication series, this newsletter, and this video series is to set you up for success each and every week so that you can deliver superior results for your clients. And we do that through the only lens that matters to your clients, the only thing that shows up on their statements at the end of every month: price. This is technical strategy. We're going to show you how we think you should be positioning portfolios to tactically outperform your benchmark. We're going to show you the why, and we're going to show you what's actually happening underneath the surface of the market's most important stories. So if you've followed my work before, you know I don't like to beat around the bush. Let's get right into it. We know that you have a lot of time. We really thank you for taking the time with us this Monday morning to see how we're looking at the market. First up, we're going to show you a couple of disclosures. Just a reminder that this post and this video series is for informational and educational purposes only. It's not intended to be recommendations specific to any particular person's financial situation. Quick preview of this week. That man over there on the left is your entire economic calendar. We have building permits, housing starts on Tuesday, existing home sales, crude oil inventories on Wednesday, jobless claims and LEI on Thursday, as well as some PMI data on Friday. But we all know it just is what it is. It's 2022, and the only thing that actually matters is the Fed and what this man says. Now, looks like it's a near certainty, 82% odds that we're going to get a 75 basis point hike, put us up to 3% on the Fed funds rate here on Wednesday. So it's really all about the press conference. You know, what does he say? The terminal rate has moved up about 2 hikes. You know, we've gone from the Fed funds rate topping out this cycle at about 4% to the market on Friday, pushed it all the way up to 4.5%. You know, that's going to be really, really key to the market story, is how much more. We know they're hiking 75 this week, but how much more do we have? How aggressive are they going to be over these next 6 months? Where do we start? All that's going to be very, very key. And we know that, you know, people will be parsing every single word, trying to determine which words were pulled out of the statement and things like that. We aren't going to do that. We're just going to analyze price. But it would be foolish to not think that this is going to be what everybody else is watching and what price is likely to revolve around. So how do you actually invest for this current market environment? Well, first up, we're going to show you 4 charts that you're going to see in every single Monday morning playbook, 4 graphics, I guess you will. 3 of them are asset allocations, but the very first one is just something that we're calling the beta barometer. And it is my qualitative assessment of all the quantitative data that we look at. And it's really just to help guide you just in the most high level way. How aggressive do we want to be relative to our baseline asset allocation, or what we just kind of consider neutral? You know, you put your client's financial plan in e-money or whatever, and it says that they're a 60-40, but you want to be tactical around that. Do you want to be at 65% equities, or do you want to be at 50% equities? This is kind of how we're helping you answer that. One beta of 1 is, of course, you know, kind of that benchmark neutral risk target. 1.5, your, you know, beta, if you were truly running the numbers, could be more aggressive or less aggressive than that. Same thing on the downside, but we put ours, the most conservative we're going to put it at is 0.5. The most aggressive we're going to go to is 1.5. We're at 0.8 this week. And so that is not the most conservative that we could be. You got to be really, really careful. You really got to be picking your spots and really be kind of, you know, in those selling those rallies before in clear downtrends that just aren't adding up to really get that conservative. But we are more conservative than the benchmark, and we think that makes sense. We're going to show you why a little bit later in the webinar. Looking specifically about asset allocation, this is all about trade-offs. It's the high level. Where do we want to be overweight? Where do we want to be underweight? Where are we seeing the relative trends, the relative pair trades? Again, if you followed me before, you know that what is really, really key, and you're going to see this in all the publications with Beat the Bench. How you beat the bench, in my view, is by thinking of your portfolio as a long-short strategy relative to the benchmark. You got to find that benchmark, and you got to really think about, where do I have the opportunities? Where are the opportunities to be overweight? Where are the pair trades that I want to be underweight. It's not just about what do I think does well. You're taking from something, and you really got to make sure that what you're taking from is what underperforms, what you're adding to, more so than the benchmark. And then just making sure that those pair trades work, and then pulling back to neutral and hugging that benchmark when there isn't a trade, when there isn't a good opportunity, and only picking your spots kind of like a true trader with just a cash benchmark would. And so when we pull back, we kind of look at a true 60-40 portfolio and we think, how do we beat this? It does look like we actually should be underweight stocks and fixed income in favor of cash right now. Again, we're going to show the charts, but the clear downtrend of both stocks and bonds has us pretty wary and much more comfortable with holding above average levels of cash. We also stuck in, you may or may not use these in your portfolio, but of the 5 potential asset classes we've got on the screen that we would ever allocate to in this allocation, we have diversified commodities and then gold, which is a little bit different. We are putting a 5% allocation to diversified commodities. It's small, but it does have a better relative trend than stocks versus bonds. So if you do have that kind of tactical leeway, depending on the investment vehicles we use, I think that makes a lot of sense. Global equities, you can use this kind of just as that sleeve. You can use it if it's an all equity portfolio, but just how do we think about US versus EFA versus emerging markets? The global equity benchmark that you see there has 62% US stocks. That's just the MSCI All Country World Index, 28% in foreign developed, mostly Europe and Japan, and then 10% in emerging markets. We're 100% in the US. There's just no case, I'm sympathetic to the passive, diversification and things like that. But the fact is, we'll just change our mind. If foreign developed and emerging markets start showing signs of life and outperforming, well, then we'll just allocate to them. But that's absolutely not what we're seeing right here. So within, how do I allocate assets across the globe? If I was only given these 3 choices, we would put 100% in US stocks because it's just kind of the best house in a bad neighborhood right now. Last one also will always be fully allocated just because you can pair it with the allocation, the balanced allocation and our overall beta view. And we just really want to show the pair trades. Where do we see relative opportunities within US equity sectors? We are underweight information technology, consumer discretionary, and communication services. The overweights, industrials, consumer staples, and utilities. Obviously, the defensives, consumer staples, and utilities, probably an obvious choice. A lot of people aware of the relative strength those have exhibited. Industrials, we're going to show the chart, but it's actually been kind of surprising, and we think it pairs well juxtaposed with the weakness from communication services. So let's get into kind of the supporting evidence, some major key charts, and then we'll also just show some interesting ones that have caught my eye over the past couple of weeks. First up, retest time. The S&P 500 broke that support range here at about 3,900. Now we printed a nice kind of hammer. This is called a hammer because we closed well off the lows on Friday, about 1%. Could be a potential reversal signal. That'd be great, but I think the bigger picture takeaway is we really broke the only support that separates us from those June lows. Doesn't mean we have to get there, but between the downward sloping 200-day moving average, we've now been below that for the longest amount of consecutive days since the great financial crisis. This is just a clear downtrend line. We think it still makes sense to be generally defensive, though not quite as defensive as maybe you could have been earlier in the year. I think the kind of, not that it was ever easy, but the easiest money to be underweight assets, risk assets has already been made. And we kind of do believe that because 36.36 really looks like it was probably the low. I've kind of said that for the past couple months. I believe that it's in the ballpark of the low. It's kind of that initial plant your flag. It's going to be a key reference point going forward. And the big question was, do we just have this V-shaped recovery like we have the COVID lows, or do we have the much more classic, what's called bang and whimper or retest? And this is the S&P 500 in 2008, 2009 great financial crisis. In the fall of 2008 is actually when most stocks, this is the percent of new 52-week lows in the S&P 500 was well over 70%. all in that one date in October. That's when most stocks made their low. And even though we eventually undercut those levels, made new lows, less stocks made their lows. And then we continued on. That kind of became a reference point for the market. Other times you see it, we don't quite get to the retest. Maybe we perfectly retest it, but it's somewhere in that range. And I think if you look at a lot of the internal metrics, the really extreme selling that we saw in June, I think we've checked that box. Open to being wrong, but I think that that's kind of the way I want to think about things right now, is more likely than not, without a lot of internal deterioration and a lot of the key things we're looking at, big changes, really got to think that the closer we get to 36, 36, the more likely it is to be an opportunity to actually increase that beta barometer, get a little bit closer to neutral, even recognizing we're probably going to still be below a downward sloping 200-day moving average. Again, why do I think that? We're cutting over to the NASDAQ, cheating a little bit because the S&P 500 did see by a slight amount a peak in new lows when it made its lows on June 16th, but the NASDAQ didn't. And I think that's really important because the NASDAQ has been where the worst of the selling has been. You can see new highs started drying up all the way back in February of last year for the NASDAQ. And then we started seeing the new lows just, we're hitting a ton of NASDAQ stocks hitting new lows right at the beginning of the year when the price had barely even corrected. But they peaked in May. And so we went down here in June. We actually saw less NASDAQ stocks make new lows. We saw the ARK stocks not make new lows, the ARK ETF, IPO, all these are really the worst performing things so far. And that was kind of the first clue that we could set ourselves up for a pretty good rally, which we definitely had, retracing more than 50% of the decline in that rally off the June lows. Market's not through with us yet. We'll see how it shakes out, but I think this is really key. I think it's going to be really hard to get the NASDAQ 52-week lows to eclipse what we saw in May. And so even if price can get down there and retest, I think we've seen the worst of it. So we're underweight stocks based on that, still cautious, not ready to be overweight yet, given what's going on and the fact that we're not at those lows. We're still in a downtrend. We're also underweight bonds. And that's just, we think, prudent given the absolute look at bonds. This is just a chart of AGG, the iShares Core US Aggregate Bond Index. Major breakdown below a 10-year support line. Broke down, retested that. This looks like a classic pullback or throwback to the resistance point, soundly rejected, and we're right back here on the lows, closing last Friday about 98.9. It's just an ugly chart for ag, and even though you've got a little bit of a bullish momentum divergence, I just can't be excited about core fixed income if we're below 104. Still want to be under this. It looks like a coin flip to me if it's going to be positive or negative. So, if the expected return is 0 based on those probabilities, I'd rather just own cash. And maybe we can actually do better than cash. Kind of a weird thing, not going to be something you typically see in a technical presentation, but best risk reward right now, call your fixed income desk. I know a lot of people might just use ETFs or mutual funds, might have to go a little old school and just call up the fixed income desk, because here's AGG, that ETF we were just looking at. That's a 3.51% SEC yield right now, and you risk 6.5 years effective duration. If interest rates keep rising, which is still our base case, you can really quickly lose out on a substantial amount of that interest. Meanwhile, if you can just go out a little bit, a 1-year T-bill crossed 4% on Thursday, yields 3.96% as of Friday. Even the 3-month down here will get you 3%. So 3 months, unless you really need that cash tomorrow, in which case investment's not going to be your first concern, you can do a lot better by actually investing in T-bills, higher yield, don't have the interest rate risk. So something to think about there. Going to the global asset allocation, this just is what it is. Like I said, maybe it'll change. We'll be glad to be wrong. Maybe eventually, it will turn. But this is EFA, the iShares, just FIFA, foreign developed ETF relative to the S&P 500. And this is the chart all the way back to 2007. And so whether you're looking at the last 1 month or the last 1 year or this entire 15-year period, it's just straight down and to the right. It continues to underperform. A little bit less sure looking at the charts of some of the European markets that we've bottomed there. just really don't see any reason on a tactical basis to be allocating to foreign developed markets. And emerging markets, not too much better. China looked like it bottomed. Now maybe we're going in for the retest, but some of the big China stocks did bottom back in March. EM was a little bit better, at least China was a little bit better, but the rest of EM really, really hurt by dollar strength. This is EEM, closed at a 52-week low yesterday, and actually kind of looks like a really important support point there. Relative chart, this is not as long as the EFA chart, but you just look over the past year or so, it's also just straight down and to the right. All right, let's talk about the sector model. Maybe one of the biggest things, like you're a technician, you're a trend follower. What do you mean? You didn't mention energy. Are you neutral on energy? Yes. No, I recognize that it is still up above a rising 200-day moving average there, but I think a lot of that is just a function of volatility. I am not excited about being overweight energy. We peaked out in absolute terms and in relative terms all the way back in June. Things looking really, really volatile. I respect the relative strength, but just in absolute terms, you know, this kind of, it's not a coincidence that these two charts look the same. Energy has been so volatile that, you know, if it goes up, it outperforms, but if it goes down, it underperforms really regardless of what the market is doing. And that, you know, just shakiness combined with the commodity space really just has me not excited about betting on it. Oil prices topped out in March. Big failure here at 115, was always unable to sustain up above that. Also couldn't hold support at 94, and so we're just kind of carving out a little bit of a neutral trading range as the 200-day moving average starts to flatten out. And nat gas prices, they've been what, you know, was able to drive the relative strength even with oil going the wrong direction for energy stocks. But now they're struggling to get through their June highs up at, you know, $9.6 or so. Big time bearish momentum divergence, upper end of that range. Maybe there'll be an opportunity to turn positive on energy stocks. Maybe there'll be an opportunity to turn negative on energy stocks. For now, I just think neutral and not really making that bet is the most attractive thing you can do in a portfolio. Talk about industrials. This is kind of, like I said, maybe a weird one on the surface, dollar strength, global recession fears, but I mean, just look at the relative chart versus the S&P 500. Up above a flat to slightly rising 200-day moving average, solid relative strength so far this year, despite the pullback driven by FedEx and everything trading in sympathy with it. On Friday, you know, this still looks pretty solid to us, and it looks especially solid compared with communication services. Breaking major support here, new lows around $53 a share. New relative lows. It's only been a sector, or at least it's new sector since 2018. So it's hard to graph what is extreme, but I think anyone would say this is really, for any sector, historic underperformance. But you just got to continue to be underweight, I believe, until this shows some kind of change or some kind of signs that it's actually turning or putting in a base. 52-week absolute lows, 52-week relative lows. We want to continue to be underweight anything that looks like this. Big change, tech. Tech has been not good. It's been pretty poor, but it's been the best growth sector, and that's really just due to the strength that Apple's had. Our deep dive, which is going to be our Tuesday publication, going deep under the surface of the market's most important stories or sectors, whatever's going on, whatever we think is important. Maybe it's the thing that nobody's talking about that we think you should be looking at. But we're going to look at technology tomorrow. We're going to look at Apple, which has really been driving so much of this strength, making XLK look a lot better than it should, except suddenly it's not. Apple's not holding up so well over the past month, and XLK is going in for a big test at about 123 here, closed at 52-week relative lows on Friday, but you know, you can see the significance back here of the big blow off top and consolidation we had in the second half of 2020. This is a major level for XLK, and I think probably the most important thing to keep on your screen over the coming week is XLK going to hold that. A few other charts to note just to wrap up, no particular theme to these, but things that we think are very important. The dollar remains a problem. It's up here 109, 110, didn't get to a new high, which tad bit interesting on Friday with the equity market weakness, but regardless, this is just straight up and to the right. It's going to take a lot of work to change this trend. And the more this trends up, the bigger of a problem it is for risk assets. It's been a problem for gold, maybe not traditionally a risk asset, but it does have the volatility of one, and it certainly hasn't performed well in this inflationary environment. broke down, on Thursday, tried to pop back up above. The only thing we can really say about this, there's no reason to own it, but bullish momentum divergence. Also saw some very smart people point out that things like silver did not confirm that move. Silver tends to act like a junkier version of gold. So it even moves whatever direction gold moves, it moves down more or up more. It didn't move down, so maybe we can pop back up above $1,678 an ounce, which is the key level for gold. But if we're below this, most likely it looks like, the target on this pattern is down here in the $1,300 range. And even if you pop back up, you're just into a dead money volatile range. So we don't like gold at all. I think one of the most bullish charts I have in this deck is this one. It is the ETFs from Invesco, equally weighted consumer discretionary versus equally weighted consumer staples. This has been a incredibly valuable chart if you were going to look at only one thing for your macro and asset allocation view over the past couple of years. This would be the one. It was going straight up the final 9 months or so of 2020 and all of 2021. It's been going straight down since November, December of this year. Bottomed right at the turn of the first half, June 30th, I believe, was this low. But what's really interesting is right around here is August 16th, where the S&P 500 topped out. We're virtually flat, even though the S&P 500 is down sharply. And this kind of looks like it's trying to turn a corner. We'd love to see it break this neckline, a little bit of inverse head and shoulders pattern. But already the fact that we've broken this downtrend line and the fact that, it's not confirming, it's not moving lower all of a sudden. And again, this is equally weighted. So it's not just, flight to Amazon, and Tesla's been doing pretty well in relative terms. It's not that. For whatever reason, the discretionary stocks are no longer underperforming the consumer staple stocks. I think this could be pretty bullish if it turns. It might be a little bit of a sign that maybe that retest doesn't even get to 36. We'll see how it acts, but I think very, very interesting that this is not down here on fresh 1 month lows like the S&P 500. Seasonality, this is weekly seasonality for the S&P 500. Just a quick call out that the next 2 weeks, two of the weakest of the year, especially the last one of September. So be aware of that. I saw a cool chart. Again, I think seasonality, some people dismiss it. Sometimes maybe you just don't realize that there's a reason for it. I saw a cool chart from another Substacker, Mr. Blonde, just earlier this weekend, kind of pointing out that this is when companies, kind of like FedEx just did, tend to have to start looking towards next year and kind of dial back. So you're more likely to get earnings revisions or pre-announcements, or they just start dialing back expectations for next year as we kind of head in to the end of Q3. So something to think about there regardless, kind of maybe brace for a little bit more volatility, but things get very, very bullish in the second half or the final couple of months of the year. Two more charts that we've got for you today. Watching 6 month lows. If I'm wrong about how June was the lows and that most stocks made their lows either in May or June, then we're going to see 6 month lows creep up. And we did see 12% of the S&P 500 make a new 6 month low on Friday. It's the highest reading since July 14th, I believe. Just something to watch. Again, we're well short of these levels. I don't think we're going to get there, but absolutely something we want to watch there. And then the last one, going to be very, very key. I will not be listening to the Fed press conference, but I will be watching this. This is the chart of the 30-year Treasury yield. As long as we are up above the highs, of the 2018 highs of 3.38%, we have to think the risk is to the upside, and 4% is in play. So 3.38%, but again, that's why we're continuing to be underweight fixed income. Just think this chart still risk to the upside. Too strong of a trend to say that we've turned here, and I'm just not excited about betting on bonds or buying into fixed income quite yet when the Fed is showing no signs of pivoting and really can't even if they're thinking about internally, they can't let the market know that they're thinking about it. So that is what I have for you this week. Thank you so much for joining us again. Be sure to check out the deep dive. It'll be out tomorrow. We'll also have our individual equity report, stocks, the good, the bad, and the ugly, out on Thursday. It'll look at individual equities, attractive long setups, key stocks to watch, as well as short setups and stocks to avoid. So that is what we have. We'll be back next week for paid subscribers only. But if you have more questions about Beat the Bench, would like an extended free trial, let me know. Email me at scott@beatthebench.com, and we'll make that happen. Again, thank you so much for joining us. Everybody have a good week.